We had another very strong bullish day here in the United States with the S&P 500 up about 0.7%. Not only that, but we had broad-based participation once again with about 79% of the stocks in the market closing in the green today. In fact, we had just one sector closing in the red, and that was the utility sector, just by a skosh. On the other hand, we had several sectors that were up well over 1% today. So in tonight's video, we'll take a look at all that information, see what it means for our posture. We'll also take a look at sector rotation with our sector selector tool, and we'll see something that's happened on that for the very first time in over 3 months that is noteworthy. We'll also take a look at risk appetite by looking at what's happening with things like junk bonds right now in emerging markets. And then at the end of tonight's video, we're going to do an iron condor on a well-known bank here in the United States. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's June 13th, 2023. For those of you that are new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. Remember, at the bottom of those emails, you'll also find which stocks in the S&P 500 are giving you overbought and oversold cluster signals. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. And I really appreciate those of you that click like and retweet on those Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as we pull up our S&P 500 heat map here, you can see it was quite the glorious day there for the bulls, kind of continuing the theme that we've seen so often here more recently, with a lot more bullishness than bearishness as the market has continued to grind higher. We hit yet another 52-week high here today, following up yesterday's impressive move. So it is natural to assume that with markets at 52-week highs, there's a lot of participation helping along in that effort, and today we certainly got that. A couple of them that stand out immediately to me are probably in your corners there. First of all, NVIDIA had an incredible day. Of course, that continues the AI craze that this market has found itself in here, this current moment, this era. It kind of reminds me of that Saturday Night Live skit where they say, you know, I've got a fever and the only thing that can cure it is more cowbell. Well, if the market's got a fever right now, what can cure it is more talk about AI. And we've heard all kinds of things about how executives on their conference calls, their quarterly earnings reports, if they want their stock price to go up the next day, they should say artificial intelligence or AI dozens of times during the call, if at all possible, and that will spur the market along to buy them up. It's somewhat reminiscent of what we experienced back in the dot-com era, which is when I first started kind of getting invested myself back in the year 2000, and we saw the same type of behavior back then. Now, of course, we know with the benefit of hindsight that the dot-com bubble was somewhat right in their initial direction. In other words, the belief was the internet was going to change the world and people were going to mint money by buying internet-related stocks. And so a lot of companies, even if they had nothing to do with the internet, would just slap a .com at the end of their name and kind of rebrand themselves in front of investors and traders. And those very investors and traders would send those stock prices higher and higher and higher. Well, here we are, 23 years after that, and the direction was right. The internet did change the world. It was a massive success and a huge productivity win for many businesses out there. But what didn't work out quite as nicely for some that were involved is that the stock prices were way, way, way ahead of themselves. And some of the companies that had no business calling themselves internet companies eventually got outed by the market. As Buffett says, you only find out who's swimming naked when the tide goes out, right? And so it'll be interesting to see if we kind of follow suit in this current era with so many companies trying to jump on the bandwagon, claiming that they are now artificial intelligence companies, or at least using it to benefit their business in such a way that it's should deserve a much higher stock price as a result. And whether we get to such extremes that we did back then, but you can kind of get the sense that it's happening at least in a minor way right now. And I'm somebody who personally believes in artificial intelligence, just like I believed in the internet back then. But the real question is the value awarded to individual businesses appropriate or not? And some things can spiral out of control in both directions, right? The pendulum swings to extremes, both extremely overvalued and extremely undervalued, depending upon what the prevailing sentiment on Wall Street is at that moment in time, regardless of what the underlying business operations would suggest in those extreme situations as well. So it's going to be really interesting to see how we move forward here. But I do have hope that artificial intelligence will help our economy become more productive as time goes along. But I also have a fairly strong sense that some companies will go strongly up in price, and we will look back with hindsight, realizing that they went beyond their skis a bit and probably didn't deserve to have the valuations that they had at their heights. So let's all see how that shakes out moving forward. But one of those names that is really driving this AI theme at the moment, of course, is NVIDIA. It is a company that we actually own in my top-down trend trading class. We bought it in February, and we're up 95% in that short amount of time. And that is not normal when we're talking about a company that today is worth $1 trillion. So when we bought it, it was basically a $500 billion company, and that was 4 months ago. That is not normal at all. Sometimes you see that happen with like penny stocks, or some stock that's going to completely change their business trajectory because they're buying out one of their competitors or something, very exaggerated like that. But when you're talking about a $500 billion company basically doubling on itself in 4 months, we're talking about some very, very extreme market behavior here at the moment. So anyway, NVIDIA was a big reason that the tech stocks did well today, up basically 4%. Now in the other corner, we see another champion. This is another one that a lot of people have doubted. As I mentioned in the last Market Outlook video, we actually have a bearish trade on it, but it was a bear call spread. So the good news is I knew how much we were going to lose ahead of time, and I could position size accordingly with just one contract. Whereas if I were just short selling Tesla, because for some reason, if I thought it was overvalued or whatever my thesis might be, some people, when they short stocks, they don't know when to pull the ripcord. And I have a feeling there's probably a lot of people that are trapped in Tesla shorts right now, just watching that stock go up day after day after day. It's been extraordinary. I believe they said on CNBC that this is the longest streak of wins in a row in Tesla's history. Now, we're not talking about a company that's been around as long as Procter & Gamble or something like that, but still, Tesla's been around long enough where we're currently, right now, in the midst of its longest streak ever. And it's 13 days in a row that it has been up. It has been astonishing to witness. So anyway, for those of you that are long Tesla, congrats. You've got yourself a nice winner on your hands there, and it was up another 3.5% today. So those two in the corners were probably the drivers of a big portion of the market today, because Tesla is not quite $1 trillion company like NVIDIA is, but it's knocking on the door of it once again at only $200 billion less than that. At $800 billion is their market cap. So anyway, both of those juggernauts really helped the market along today with 3 to 4% types of moves. The other mega caps kind of were just blah. They didn't really make major moves. Microsoft was decent at a 0.74% move, so it basically matched the market today. Apple, believe it or not, was actually down a touch. It was down 0.26%, despite the S&P 500 being up nicely today. Remember, that doesn't happen a whole lot. Usually you need the support of the most important company in the market when the market itself has a reasonably strong directional day. And today was reasonably strong. It wasn't, obnoxiously strong or anything like that, but, a 0.6 to 0.7% move to the upside is a strong day. It's better than average type of a day. And you did that all without any help whatsoever from the most important company in the market, Apple, which was down 0.26% today. Google was basically flat, nothing to report there. Basically, just a lost day there for Google shareholders, or Alphabet, if you want to call it that. Amazon, somewhat similar to Alphabet. Amazon was basically flat today, just closed barely above the flat line. So not any sort of benefit from Amazon, not any sort of benefit from Apple, not any sort of benefit from Alphabet, yet we had a market that was up between 0.6 and 0.7% today. It's a pretty good sign because it tells you this is not just the mega caps that are leading here. This is a story that has broadened out considerably on a number of these days here recently, and all things being equal, that's a positive sign for the market. That's a bullish feature of the market, and that's in addition to what I mentioned earlier. We're literally at 52-week highs. It's hard for somebody to claim that markets are bearish when you're literally hitting a yearly high as we speak. Yet there are some people out there that will probably try to make that claim right now, right? They might come kicking and screaming, but eventually the markets do go higher over the long term. Now, you could probably make the argument of whether we're a little bit overheated in the really short term, but in general, the trend is in place and has been in place for some time now, that the upward trajectory of the market has been established and is at least worthy of recognizing and respecting, even if you don't believe it, right? There's always going to be doubters, and you've probably heard the phrase, markets climb the wall of worry, and I kind of feel like that has never been more true than this year, because this has been a hated rally, and it feels to me like there are too many people that are either bearish or at a minimum in too many cash products right now. And I could even consider myself one of those people, because many of you know I've been dabbling with some of the treasury bills here ever since October of last year. And once they started offering 4 and 5%, basically risk-free returns because they're U.S. government bonds, I thought that was an attractive alternative to the market, which was a little dicier during moments in time over the last half of a year. So even myself, I can see by my own tactics that I've had with my own money that, looking back, would have I been better off putting that money that I had in the government bonds into the NASDAQ? You better believe it, right? But you can't go back in time. So you got to live with those decisions that you make. And I do wonder if there's a lot of people out there like myself that got kind of a little bit more interested in those money market funds and higher yielding assets here that seemed safe at that time. And it was those that took that risk in the growth stocks out there that are now receiving the rewards above and beyond those of us that thought we were doing the safe thing, right? So, there's an argument that can be said that there is a lot of money on the sidelines in either cash in the brokerage accounts or at a minimum in government bonds or in money market accounts that are earning above average yields compared to historical standards, at least in the last decade or so. And that is money that could very well eventually find its way into the stock market if that money thinks that the stock market is running away without them, right? And then all of a sudden you're trying to play that FOMO game again, right? The fear of missing out that we heard so much about a few years ago after the V-shaped rally for COVID. Who knows? Maybe we're in the midst of one of those right now as well. And every minor pullback that the stock market is willing to give us gets immediately bought back up and just frustrates those that have too much cash on the sideline, or worse, have too many bearish trades going at the moment. So it's been an interesting market, to say the least. And that's why it's important to respect what price action is telling us, regardless of what sort of thoughts we may have in the back of our mind as to what should be happening in the marketplace. It's not up to us as individuals to suggest what should be happening. It's up to us as individuals to recognize what is happening. And what is happening right now is bullishness across many, many financial markets. Today, another one of those very strong days. Now, before we get too excited, we do have to remind ourselves we have an important day tomorrow. We had an inflation number here this morning that the market obviously digested quite well, but tomorrow is the Fed day. And so we will hear from Jerome Powell and company tomorrow as to what their plan is with interest rates, not only with tomorrow's decision, but moving forward as well. Right now, the market is expecting that the Fed will what they are referring to as skip. So a little bit different than pause, because pause gives you the sense that it's on hold or frozen or something along those lines, whereas skip kind of gives you the impression that they're going to just let it go without an interest rate hike tomorrow, and then reevaluate in the next meeting coming up a little bit later this year, where they very well might raise interest rates at that time. So they're trying to, wordsmith the situation to not startle the market too much. But right now, that is kind of the prevailing thought amongst market participants, is that we will not hear about an interest rate hike tomorrow, but it doesn't mean that we're done with interest rate hikes fully. It's kind of a wait and see how the data comes in and what inflation does, between now and the next Fed meeting after tomorrow. So let's see if we can pick up on any clues from Jerome Powell tomorrow in his statement or in the press conference, and maybe that will help guide investor decisions beyond that point. In terms of the areas that were out of favor today, there really weren't many. I would say that utilities appeared to be out of favor to a degree. As I look at this utilities sector here, it does seem like we've got more red than green there. Other areas, boy, it's real hit and miss. I would say that communications was kind of stagnant because many of the telecoms were red today. However, offsetting that is a really green day out of Netflix, which was up about 3%. And then, as I mentioned before, Alphabet was flat, so was Meta. So kind of a blah day there out of the communications area, but not necessarily negative the way that it seems a little bit more negative with utilities. And then for the other red squares and rectangles, it was real hit and miss. It didn't seem like it was much of a theme. You had a smattering in, the discretionary. You had a little bit with MasterCard and Visa in the financials. You had a little bit there in the healthcare with United Healthcare and Elevance. You had a little bit there in the consumer staples with Procter and Pepsi. You had a little bit in the industrials with some of the defense and military companies, Lockheed Martin, Boeing, Northrop Grumman. But what I'd also say is the industrials have been really impressive. We concentrated on the industrial sector yesterday morning in my top-down trend trading class, and there's a lot of really stellar-looking industrials charts here at the moment. I happen to be hovering my mouse over GE just by happenstance, but that is one company who, if you look at their stock price or their stock chart, you'll be impressed by their trend right now. And so if you believe that strength begets more strength, and the trend is your friend till the end type of a mindset, the way that a lot of trend traders think, GE has been working as a trend trade this year, and that might be new information to some of us. I think GE has had so many black eyes here in recent years. It feels like it's got beaten up left and right, where it just is a shadow of its former self. But don't look now. If you pull up a 6-month chart on GE, you might be surprised. That sucker is moving to the upside, and they're not alone. There's a lot of industrials companies right now whose charts look really, really strong. Not quite as strong as the technology charts, but nonetheless, they're not that far behind at the same time. All right, let's go ahead and take a look here now at what the specific breadth numbers were. And so let me pop over here to the Market Watch tab, and as you can see, I've got the S&P 500 public watch list pulled up here. And today we had about 395 stocks out of the S&P 500 that closed in the green. So that's good for about a 79% hit rate. That's a very strong day, right? Basically, 80-20 split there pretty much. So, when you have 80% of the stocks or 79% of the stocks up, that is broad-based participation. That is not just a fluke like we see occasionally when you have just a handful of the mega caps up. This was a broad-based advance today, a very strong one across the board, and really the only group that set out wholesale was the utilities, as I mentioned before. So this is what we want to see, right? You broke to a new 52-week high yesterday. The last thing you want to see is a failure of that the very next day. Instead of a failure, what we got was broad-based participation across the board to the upside on another fairly sizable day for the market. Taking a look at our foregrid now, you can see the S&P 500 was up 0.69%. So again, it's not going to knock the socks off you or anything like that, but that's a good day. That's a well better than average day for the market. That follows up yesterday's new 52-week high day to yet another 52-week high today. Notice that we're starting to see these green tags show up here now all of a sudden. It's been a while, right? It's been over a year up until yesterday since we saw those. Some of you might be newer viewers of this video and you might not even be aware of those tags. That's how long ago it was. But remember, in normal market conditions, when markets generally are more bullish than bearish, those yearly high tags show up quite often. But it's been over a year since I've been able to have that conversation, at least on the S&P 500. With the NASDAQ composite, we actually did break to a yearly high last week. But anyway, it's nice to see those, right? That's yet another sign that this is a rally that is legitimate. It's not just some sort of a statistical fluke or something along those lines. We're talking about billions, if not trillions of dollars of market cap that is being pushed to new 52-week highs. That's serious money. It's not just Joe and Jane Trader, operating out of their basement that is pushing the market to a new high. We're talking about billions and billions and trillions of dollars that is required to push the market to a 52-week high. So whether you think it's deserved or not, I'll let you decide on that. But the point is, it's happening with or without your thoughts. And these are nice looking charts, right? You look at the S&P 500 up at the top, hard to argue with that, right? You see an index doing what you want it to do if you want to be bullish. And some of you want to be bearish, that's a different story. But if you want to be bullish, it's effectively what you want to see, right? You see a breakout above the falling 30-day moving average that happened back here in March just after the banking crisis, right? We did have some concerns at that time. But price activity responded fairly quickly, saying, yes, it's true, the banks are a problem, but the banks are a relatively small part of the overall S&P 500, so we can take off without the banks. And then you had a little bit of time where you kind of spent a little bit more time going sideways, but notice how you never really breached the 30-day moving average aggressively during that entire run. You had a few times like right here, and during this week right here where you went down and touched it, in addition to this one right here, but you never saw multiple days in a row where it closed below the moving average. Isn't that interesting? You had one day right there, another day right there, another individual day there, and another individual day there. So since we emerged above the 30-day moving average back at the end of March, we've only had 4 individual days that we closed below the moving average, and none of those instances did we have back-to-back days. In other words, the market was immediately bought up that day when the market recognized that as a buy the dips type of a mindset right there, right? That is stubborn behavior to the upside. You'll also notice here that, of course, the green line on the S&P 500 remains in the upper reversal zone at about 95 as we speak. Remember, it only goes to 100, so we're in the upper echelons here. And that is as a result of us closing near the highs of ranges so often. Even today is another good example of that. Notice that 3 out of our last 4 days, first of all, we're up 4 days in a row on the S&P 500, and 3 out of those 4 days, we closed at the high of the day, or effectively the high of the day, with this one right here, yesterday, and then also today, closing basically near the high of the day, giving you the impression that had the markets been open longer, we could have very well gone up even further. That's how much buying demand is in the market right now, whether it's short covering rally or whether it's deserved or whether the market is expecting AI to, help a lot of companies become more profitable in the future. Whatever the reason, who cares? What's happening is the market is going up right before our eyes. And so that's what you want to see if you want to be bullish. And so tomorrow, will things change with the Federal Reserve? Perhaps. Remember, in a way, Jerome Powell doesn't want to see this. He's got a problem, and that problem is inflation. Now, a lot of the inflation reports we've been receiving here recently have shown a pullback in inflation numbers, but what he also knows is that the stock market has kind of a wealth effect on a lot of its participants. When the stock market is at 52-week highs, a lot of investors feel wealthier as a result of that. What do wealthier feeling individuals do? They go out and they go buy a new boat, or feel more confident in buying a second home, or other things to kind of push money into the economy. And while that sounds great on the surface, for most of us, remember, to Jerome Powell, he's probably going to cringe when he even thinks about that sort of thing, because he knows he has not yet put the nail in the coffin of inflation yet. So who knows what happens tomorrow, but could we have a repeat of the Jackson Hole incident when he started talking a lot tougher as a result of the market not really believing him? There's a lot of people that say that he has a credibility issue, so maybe he wants to correct that tomorrow and comes out talking tough again. Who knows? On the other hand, there is maybe social pressure or even political pressure for him to just keep the status quo. I mean, after all, when markets are going up, most people are happy. He wants to be liked just like all the rest of us as individuals would prefer to be liked than hated. And so maybe he's satisfied with seeing some of the inflation numbers coming down, and he knows that market participants are reasonably happy with him as well because stock prices are going back up again. So, that could play a little bit of a role as well. After all, Jerome Powell is not a robot. He is human like the rest of us. So, that could play a minor role there as well. So we'll find out more tomorrow, but what we do know is going into the announcement, markets are incredibly bullish here at the moment. There is no denying that. And look at all that green background colors of the chart. This is not like a recent phenomenon. For the last 3 months, the S&P 500 has been telling us that we have not only a bullish posture, but a strongly bullish posture for most of that run. Remember, that's the darker green background colors. Speaking of which, just below the S&P 500, we have the NASDAQ composite. And that's an even more impressive story than the S&P 500 itself. Look at the color scheme of the background color of the NASDAQ. In fact, I'll right-click on it and I will zoom in or maximize the cell for those of you that are on a cell phone watching this right now. There's one color that should stand out to you when you look at that background of that chart, and that color is dark green, right? You have a little bit of the light green right over here. That's it for the light green. Just these 3 days right over here in the middle of March. And remember, that was just as the banking crisis was kind of getting wrapped up from its height at that moment. Otherwise, all the rest of the green we see on the chart is the darker form of green. We do have a few sporadic pink areas that show up for 1 day right here and for 2 days right here. And then, of course, we had the darker shade of pink back here when we were in the heart of the banking crisis. But the point that I'm trying to make here is when you look at this full 3-month chart right now, there is one color that should stand out like a sore thumb to you, and that is dark green. And what that means for our purposes is that in all of those candles that has a dark green background color, those were strongly bullish postures. That's how we read that particular technical indicator. So at a bare bones minimum, had you just simply been following the interpretation of the market forecast on the NASDAQ, this would have had you in a very bullish position for this 3-month process. Of course, it's always easier said than done, right? In hindsight, we know for sure. In real time, it's always a struggle because we're grappling with our own minds and our own emotions and all the negative news stories and all that kind of stuff. But purely from a technical analysis perspective, I would say the market forecast did its job very, very admirably with the NASDAQ for the last 3 months. So today we were up another 0.83%, and as I alluded to before, the NASDAQ also hit another 52-week high here today, not only on an intraday basis, but a closing price basis, just like the S&P 500. So it's all systems go there as well. Now the two charts on the right have not been quite as aggressively bullish as the two charts on the left, and that's okay. Remember, all markets are a little bit different. But the good news is we're starting to get some assistance from those charts now. Remember, for a while, it was real hit and miss where you kind of had like your haves and your have-nots, where you had the S&P 500, the NASDAQ as the haves, and you had the Dow Jones and the Russell 2000 as your have-nots. Well, as we move forward to this exact moment in time, I'd say we are 4 for 4 with the halves. In other words, we have dark green background colors on all 4 of these charts, and we have for the last 1 week plus. What I was referencing before was earlier than just this last push that we got out of the Russell 2000 and this last push that we got out of the Dow Jones Industrial Average, we did have more wear and tear, right? We've got to be honest with ourselves there. It wasn't exactly a layup. You had the Dow that looked like it was really slipping and forming lower highs and lower lows. It was carving that out, and it's not a great look. But like I mentioned to you guys when I was with you on Thursday, one interesting aspect of the Dow and how you interpret the market forecast information is when you come back over here to the 13th of March. Notice you had all 3 of those colored lines in the low reversal zone plotting this oversold cluster signal in the heart of the regional bank crisis. So for those that would have been brave and played that oversold cluster signal expecting a reversion to the mean, maybe they put a little bit of money into the Dow Jones. Well, wouldn't you know, that thing took off and didn't end until it plotted an overbought cluster signal with that red dot there. So from green dot to red dot, you made a pile of money. Now, if you decided to pull the plug on your Dow trade right there, once again, you were proven correct, as that then started slipping pretty aggressively to the point where you once again got an oversold cluster signal. So, maybe you shorted the Dow up here and you bought it back right here. And now, of course, you're watching that sucker rally once again. So that's been kind of interesting and fun to see play out. Remember, it rarely works out the way that you want, like in a textbook situation. But this is a good example of how that can play out for you if you're trying to play the extreme moves of those charts. And remember, all of you that have premium Market Scholars subscriptions, you have access to our charting package here where we'll help you plot those little green and red dots on your charts for you if you want to explore that for yourself moving forward. So the Dow was up 0.43% today, and it did break to a 6-month high today. However, notice that green yearly high tag is missing under the Dow chart, telling us that they're not quite to a yearly high like the NASDAQ and the Russell 2000, the NASDAQ and the S&P 500. Those two are beyond. But with the Dow, if we wanted to check out what their 1-year chart looks like here, you can see that we're still below where they touched their high back at the end of December. Remember, the Dow was a little bit weird last year, where it was our leader last year because it was where we housed all of those blue chip companies that held up better in a tough year like 2022. So it had a nice run into the end of the year compared to the other indices. Then this year it's been the opposite. It's been kind of the underperformer, at least compared to the S&P 500 and the NASDAQ. So we're not that far away. All we have to do is get up and over 34,712. And so that's only about 500 points away on the Dow. And, that could happen within the next few weeks as long as Jerome Powell doesn't spoil the party for us here tomorrow. So we're not quite to the 52-week high there, but we're inching our way there, and it could be feasible here in the short term for the Dow. With the Russell 2000, it's also helping support this market rally here recently, and that had been challenging earlier this year. Remember, the Russell 2000, of course, is where you're going to find a lot of those regional banks, and they really stayed out of favor for well beyond the heart of the regional bank crisis. But here in the last couple of weeks, things have changed, and we've seen those financials roaring higher here all of a sudden. And take a look at the Russell 2000. We're now at 6-month highs for the Russell as well, similar to the Dow. However, you will notice that with the Russell 2000, if we go back on a 1-year chart, we've got a lot more work to do. The Dow could theoretically get to a new 52-week high within, let's say, a week or so, if it had a strong push. The Russell 2000 is probably not going to have that happen. I mean, anything is possible, of course, but you have to kind of bank on what is realistic. And it's not realistic to expect that the Russell 2000 is going to go from here all the way up here to above 2030, where it was in August of last year in a straight line. It can get there, and it could do it by the end of the summer, let's say, but it's likely not going to happen in the next couple of weeks. Whereas the Dow, that's a realistic possibility there for the Dow. But regardless of whether it can get to a new 52-week high or not, the very fact that the Russell 2000 is contributing is a very strong sign, because that was one of the feathers in the cap that the bears had up until the last couple of weeks. As, hey, we don't have that participation from the small caps. Well, guess what? We do now. So take that one away. Cross that one off your list, right? We do have some good activity here out of the Russell 2000 here all of a sudden. So with these 3-month charts that we typically look at, we're at 3-month highs on all of these indices here at the moment. Notice the high labels are above today's candle on all 4 of these charts. That's a bullish feature, right? You can hardly argue that's bearish. And so trends are good in the intermediate term from a monthly perspective, month-to-month perspective. But 2 of these charts, the Dow and the Russell 2000, do have a ways to go before they're at yearly highs. And as they approach those, if they do approach those, of course, we will make you aware of it here in these Market Outlook videos. But in particular, the S&P 500 and the NASDAQ just continue to look like a runaway freight train. Very, very strong price activity there. All right, let's go ahead and pop on over here to the internet. I always like to say thank you to those of you that help support these presentations. Remember, they do take a fair bit of time for both David and I to do, at least 3 hours of our time to produce this free video for you. And we don't get paid to do it, so I know monetarily it doesn't benefit us to do it, but hopefully what it does is spread a little bit of goodwill between us and our audience, and hopefully that goodwill is worth something down the road, right? And for a lot of you, I know that it is, and we have a lot of very loyal supporters, and we appreciate those of you that step up to the plate and help us along on social media and other areas. I always say that as long as we're up and over 100 likes, I'm happy. And as long as we're over 100 likes, I'm happy to do a full-length video for you the next time I do it. So since we were at 110, a full 10 likes above what my threshold is there, that's why I'm doing a full-length video for you right now. Remember, for those of you that don't like these full-length videos, then don't click like for us there on Twitter. And if we're under 100, or at least if I'm under 100 on the next time I'm scheduled to do the video, then I'll just plan on doing a 15-minute version of the video, not including all the bells and whistles and the trade examples and all that other extra stuff. I'll just keep it nice and simple with just the 4 indices. So I'll let you guys decide there for the time. We will continue forward here and do a few shout outs from last video. So thank you to Brandon Walker. Thank you to Renee Etzel and Teddy Lee and Roger and Doug Hill and Robert Craig and Barry Scott and C. Becker and John Milk and Philip Barnett and Fun Jonesy and Roger Holder and Ganji Kupan and Jimmy Mill and Linda and Sonia and HR and Trunk and Jayesh and Dave and Fred and Fathi and John and Scott and Das and Prickly Trader and Sandeep and Paul and Jim and Kirkai and H. Patel and Margie and Irene and Carl and Ann. The list goes on and on. There's Kenneth and Curdy and so many others. I can't get to all of you, but I do appreciate you nonetheless. Thank you very much for your willingness to take 5 seconds out of your day to help support David and I. It means more than you know. So thank you very much to those of you willing to help us along with that. Let's also have a chat here about our sector selector. Remember that we had classes here today as well. I taught my dividend growth investing class, and we did focus on the consumer staples area. And so if you're interested in that conversation and you're a premium member, you can find that recording on our trading rooms tab there. Looking at the sector selector here, you can see consumer staples are down there second to last. Now remember, in the dividend growth investing class, we're more than happy to buy stocks that are in downtrends because it means that their dividend yields are higher the lower their stock price is. Now obviously that only works if you believe that the dividend itself is safe. So you can't just willy-nilly buy stocks in downtrends and hope for the best if you're buying junky companies. But our hope is that we're buying high quality businesses that are only temporarily down, that will snap back in coming months and years years and not only grow from a stock price perspective, but also grow our income along the way. So in the dividend growth investing class and my options for long-term investors class, we're happy to concentrate on the sectors that are at the bottom of this sector selector. On the other hand, in my trading classes, like my top-down trend trading class, which is what I developed this tool for, we are interested in what's at the top, right? Because that's basically momentum trading. It's the idea of, strength begetting more strength. That's the class where we own NVIDIA that I had mentioned before as just one example, right? And so we're looking for the market to send us cues where we don't care about the dividend at all, and we don't really care about valuation at all. What we care about is what the market is telling us that is in favor right now. Remember, part of the reason that we have the different approaches is with a dividend growth investing class where we're willing to look at what's out of favor is we want to have a good solid margin of safety and purchasing things when they're on sale because we have no intentions of selling those holdings. Whereas in my top-down trend trading class, we want to buy the stuff that's working right now from a price perspective, and we can get away with knowingly buying somewhat expensive merchandise, knowing that we are not planning on buying and holding those securities. We are trading them. So when they start falling out of favor stock price-wise, we will rip those out of our portfolio and replace them with something else. So part of how you approach the markets, whether you like the idea of buying stocks in favor or out of favor, depends upon how you plan to manage those positions, right? That can make a difference in whether you prefer to buy things that are going up or you prefer to buy things that are going down. So anyway, from this graphics perspective, remember this has nothing to do with dividends. It has nothing to do with fundamentals. It has nothing to do with valuations. What's driving the rankings on this sector selector is purely what is happening with the prices of the securities in the stock market themselves. And so right now, we had a lot of the same themes that carried us through from the prior week. In fact, this is the fourth week in a row that technology is ranked number one. And remember, they had a strong run a few months ago as well before falling out of favor briefly and then getting that all the way back. So it's been a little bit rockier there, I suppose you could say. But in general, there has been no other sector that has spent as much time in the number one position in the last 3 months as the technology sector. It has been the one that has been the most consistently up there, right? In the last 13 trailing weeks, which is what this graphic tracks, we've had the technology sector ranked number one, 1, 2, 3, 4, 5, 6, 7, 8, 9 out of those 13 weeks, with just 4 weeks in the middle where it kind of fell out of favor briefly. So on the whole, it's had a good hit rate, so to speak, in getting you into the right companies that have consistently been stronger. Communication services followed a somewhat similar path as technology, but I would say it hasn't been quite as obvious to me that communications has been a winner until more recently. You had a little bit more touch and go moments with some of those communication stocks along the way, but it is good to see them back up there in the number 2 position. I always say to my trend trading class that if I could magically wave, a magic wand and have 3 sectors leading the way in the market to determine whether the market was bullish or bearish, the 3 sectors I would want leading the way are technology, communications, and discretionary. And guess what? That's exactly what we have right now, right? So in other words, that's another way to confirm this market is willing to take risk right now. It is sending the defensive sectors like consumer staples and utilities lower. At the exact same time, it's sending the growthier areas of the market that provide more alpha generating opportunities of technology, communications, and discretionary higher. So this is another way to determine through sector rotation that this is a pretty healthy bull market that we find ourselves in the midst of here at the moment. Okay, so let's go ahead and, oh, by the way, one other thing I wanted to mention before we leave here. I mentioned this on Twitter. Remember, sometimes I'll post this to Twitter as well, so make sure you're following me on Twitter. Even if you're not a premium member of Market Scholars, every so often I'll give you a heads up in advance on Twitter as to what the sector rotation is over the weekend. And I did this past weekend for one specific reason, and that reason is because exactly a week ago, on Tuesday of last week, I told you guys in this very presentation, the Market Outlook video, that I thought there was a pretty decent chance that financials would no longer be dead last. And that was a fairly big statement of mine, because remember, had I made that statement at any other point in the previous 12 weeks, I would have been flat out wrong. But a week ago, we already saw a couple of those days where the banks were really bouncing pretty nicely, right? It's kind of that Russell 2000 effect that I was mentioning to you here just a moment ago. And so I felt like last week was probably going to be one of those weeks where you finally saw the financials get off the bottom. And indeed, they did. Not only did they get off the bottom from the 11th position and go to the 10th position, but they just jumped right over the 10th position. They actually advanced 2 slots. So after 3 full weeks without budging off the bottom, last week we finally saw movement out of the financials. We saw some life. It's kind of like Frankenstein. It's alive. It's alive. And that's a good thing in general, right? We'd rather have the banks advancing than the staples and the utilities. The banks are oftentimes viewed as the lifeblood of the economy, and you don't want to see them out of favor for too long. The fact that they're starting to participate right now is a good, healthy sign for the markets in general, in addition to the other sector rotation things that I had mentioned before. All right, let's go back on over here now to the Thinkorswim platform, and let's have a chat here about our 12 grid, starting with chart 5A. And so on this particular 12 grid, a reminder that the background colors will be green when the current posture is bullish for these various charts, and the background color will be pink when the current posture is pink. It doesn't do the back and forth, pink to green type of thing the way that our bigger charts do, just because it would be too hard to discern with these miniature charts. So anyway, it's a little bit easier to read when you know that the most recent color is reflective of what the current posture is. So let's get started with the 2 charts in the lower left-hand corner, as I oftentimes do in this part of the presentation. We had quite the move out of Treasury yields today. That probably explains why, when I mentioned before when we were looking at the heat map, that to my eye it looked like the utilities were out of favor. Remember, all else being equal, when interest rates go up, utility stocks suffer on a relative basis. And we certainly got that today. That's actually a pretty aggressive candle right there, right on the eve of a Federal Reserve announcement. Remember, Jerome Powell does not control the 10-year Treasury yield directly, but somewhat indirectly he has an impact on it. What he controls is the short-term rates. This is long-term. Nonetheless, it's kind of noteworthy that we had a fairly big spike on the eve of an interest rate announcement. You will see that we ended at 3.83% on the 10-year Treasury yield, and we basically are sitting at 3-month highs here all of a sudden, right? At least on a closing price basis. You got on an intraday basis slightly higher than this back on May 26th. But on a closing price basis today is the highest over the last 3 months. That's somewhat noteworthy as well. Remember, last year, a lot of times the markets used rising interest rates as an excuse to sell stocks off, right? After all, rising interest rates could crimp profit margins if more and more money needs to be pushed towards bondholders of those corporate bonds that a lot of corporations have been borrowing with over the last 10 years or so. But that does not seem to be stopping the market's rampage right now. The market's going up despite rising interest rates. That's probably interpreted quite bullishly there as well. Again, you don't have to agree with it, but it's happening. And it's a positive sign. It's basically saying the market can stand on its own 2 feet. It's not getting knocked down every time interest rates go up like we saw so often in 2022. Now remember, when interest rates go up, you should assume that bond prices themselves go up. And that's largely what we saw today. We saw that long-term U.S. government bonds down about 1%. You can see that we're still struggling to get above that rising moving average right there. I'm pretty sure my iron condor TLT expires this week. Remember, Friday is the June monthly options expiration. So make sure you're babysitting your positions there if necessary. So as long as this thing doesn't plunge tomorrow, which I better knock on wood, because tomorrow we could see that happen depending upon what Jerome Powell says. But as long as it kind of stabilizes in this general area, we should be able to get out of that trade with profits here later this week. But it's not like it's a healthy looking chart. It's just that fortunately all I needed was this position to kind of stay neutral. It didn't get particularly bearish. It most definitely didn't get particularly bullish. And it kind of stayed within the bands that I needed it to. So anyway, long-term U.S. Treasuries do look more bearish than bullish here, but it's not a severe decline the way that we saw occasionally last year. You will see that the foreign bond market also was down today, 0.39%. It also is below its falling moving average, but it looks a little bit healthier than what we see with TLT. This kind of is more reflective of a true sideways pattern, whereas TLT I would say is sideways to down. And then with the high yield bonds, surprisingly, they closed higher today. Now remember, we've seen this happen on occasion in the past, and it can happen because risk appetite finds its way into the high yield bond market. We had a double bonus today. Not only was the S&P 500 up nicely today, but you had oil prices up today. And remember, in the high yield junk bond market, you're going to find a lot of oil stocks. So you have the combination of stocks here in our upper left and oil prices kind of in the bottom rung there, combined together in the high yield bond market. When oil prices are up and the stock market is up, it's a risk-on mindset, and that means money pushes back into the riskiest end of the bond market as well, which of course is the junk bond market. So anyway, you kind of had some, individual dynamics helping the high yield bonds overcome what was a rising interest rate environment here today. In fact, with the high yield bonds, you actually have a strongly bullish posture and you have price above a rising 30-day moving average. Now, I would not call this a strong trend here the way that I would be looking at the S&P 500. Nonetheless, it is the leader from these three individual bond categories. And so if we do have a turn in the bond market sooner rather than later, then it's probably the high yield bonds that lead us out of that position. In the lower left-hand corner, you see the US dollar. It was down 0.32% today, but like has been the case several times in the last couple of weeks where we've had down days for the US dollar, it hasn't been violent enough to the downside to offset this incredible bullishness that the dollar had here coming out of the beginning of May. And so you're giving some of that move back, but because you're still well above that rising moving average and you're still trading near highs of ranges, you retain that strongly bullish posture. So it really hasn't put a big dent into the chart yet. That could happen down the line, but right now, it's just giving back a little bit off the top of that really impressive bullish move that it had earlier. Now, when the dollar is weak, you assume that commodities will be strong, all else being equal. Of course, there's a lot of different factors at play. Today, as I mentioned before, oil prices were up on a day when the dollar was weak, but you'll notice gold wasn't. And so that's a little bit more concerning. Usually this would be used as an excuse to push gold prices higher. Today, the markets weren't falling for it. And gold has unfortunately fallen out of favor here in the last 2.5 months, where it has a decidedly bearish tilt towards it. You did have that oversold cluster signal over here that led to a 4-day rally, but it didn't amount to much. And remember, that's oftentimes how those things shake out. You have a little bit of a reversion to the mean, but you don't have a trend change. We saw that with Bitcoin as well, right? You had that oversold cluster signal, you had that reversion to the mean, but it didn't change that the trend was still firmly negative underneath that falling moving average. They haven't been violent sell-offs in either the case of gold or Bitcoin, but they have been persistently weak. And that's not necessarily what you want to see. So at least if you want to be bullish on them. So those two are still kind of in the penalty box where you don't really feel all that confident taking bullish stabs at them. But eventually things will change. And if your bullish thesis is going to eventually play out, it'll eventually get above that 30-day moving average again. And when it does, maybe you can feel a little bit more confident about taking your trades at those various levels. But right now, I'd say both of those are in the penalty box. And I would say the same thing about oil as well. It's just that oil was up today, so it's a little different than those other two. But I'd also say the same thing there. You just haven't seen enough bullishness to kind of justify taking bullish trades in those areas at the moment. You've been far better off sticking with the obvious choices like the stock market here in the United States, or even the stock market in emerging markets. I mean, that thing is taking off. Take a look at EEM today. It was up 1%. It outperformed the US market. Remember, a lot of times when you have a down dollar, US stocks underperform foreign stocks, and that's what happened today, right? Even the developed foreign stocks were up more than US stocks today, but the developed foreign stocks still are struggling with this downtrending 30-day moving average, whereas EEM has had a jolt to the upside. They have been rocketing, and sometimes that's a measure of risk appetite as well, right? You can kind of think about EEM the way that you would think about the NASDAQ versus the Dow, right? If you thought that one of them was more speculative, the emerging stocks are more speculative than the developed stocks. If you're trying to take risk appetite, you'd prefer to see the emerging stocks leading the developed stocks. It's basically saying the market is willing to take on risk right now. It's the same philosophy of the market pushing into the NASDAQ and not so much into the Dow. So I would say that that's yet another feather in the cap of the bulls here at the moment. Let's take a look now at our sectors. And this is chart 5C for you following along at home. Here we've got a pretty good sign. We've got just one chart that is pink. It's the same one as when I was with you last that was pink, and that is the staples. It hurts my feelings a little bit. Now, I'm just joking about that, but you guys have heard me mention in the past that I own a lot of consumer staples. I do. I'm guilty as charged. I didn't buy them for this moment in time. I've held them for years, in some cases decades, because you'll find that there are a lot of consumer staples that are great dividend growth stocks that raise their dividends consistently year after year after year. But at this moment in time, their price is out of favor. And so, as I mentioned earlier when we were talking about sector rotation, for the health of the market, that's actually a good thing. You don't want to see a market led by the consumer staples. You want to see the consumer staples getting blown away by the more exciting growth areas of the market. And that's kind of what we can describe this moment as, right? You're seeing communications at new 3-month highs. You're seeing technology at 3-month highs. You're seeing discretionary at 3-month highs. You're seeing industrials at 3-month highs. I think that about does it. But one thing I'll point out is that we're not that far away from 3-month highs on the financials, believe it or not, and also real estate. Notice that both of those are on the 3-month charts about ready to break into new territory. Now you can see that at the start of those 3-month charts, they had these significant declining 30-day moving averages. So it also tells you that we're nowhere near 52-week highs on those. But hey, you got to start somewhere, right? Every 52-week high was eventually started by a 3-month high somewhere along the way. So who knows? Maybe this is the moment it starts its journey and it follows technology to 52-week highs in the months to come. We just never know. So, we can only take it one day, 1 week, 1 month at a time. And right now we're seeing progress even on what was once the ugliest charts out there. So I would say that's another feather in the cap of the bulls. I wanted to point out that we did get an overbought cluster signal on the industrials. I mentioned before that there are a lot of industrials charts breaking out left and right. Well, this kind of proves it. You have so many charts breaking out that you almost have too much of a good thing. So maybe industrials slows down here. Then again, maybe it doesn't, right? We saw the overbought cluster signal show up on communications back here in the middle of May, and we haven't really seen any slowing down there. Same thing with the discretionary. We had this overbought cluster signal that did not lead to a pullback. So as I alluded to last week when I was with you, and I said, I personally get a lot more practical information out of oversold cluster signals because I've seen them play out much more often with a reversion type of a move than I've seen the overbought bot clusters revert back lower. So in other words, I'm more interested in the green dots personally than I'm interested in the red dots. It's not to say that neither of them can work or not work at any given moment in time. They both have equal ability to work or not. It's just that I've seen the bullish clusters, the green dots, result in a reversion move much more often than the red dots in the opposite direction. Part of that is just simply stocks go up over the long term. So if you're just constantly buying oversold sectors, generally speaking, they will eventually go up. They might not go up immediately, but eventually they do revert higher because all stocks and all sectors, when you're looking at it from a broad perspective, revert higher if you believe that the stock market eventually goes to all-time highs, which is what history has taught us has been the case. So anyway, pretty strong day there across the board. As I mentioned before, the only holdout was utilities. It was down just fractionally today. All the other sectors were up, and we had some pretty big moves too. The materials were up 2.32% today, so they were the big time winner today. But we had some other good, 1% winners out of industrials and consumer discretionary there as well. All right, let's get into our trade application example. And I'm going to pull up just a swing trading chart for this conversation, chart 3A. And the stock that I'm going to bring up is Bank of America. Now, before I get to that, I will also share with you that another stock I had on my radar was Honeywell. Ticker symbol HON, I thought was setting up pretty nicely for a bullish move. But what I recognize with the industrials overbought cluster signal, maybe that had a little bit of an impact on me. And of course, Honeywell being a key portion of the industrial sector. But in addition to that, I didn't find that the options were liquid enough for what I was hoping to accomplish. And so I did have to pass eventually on Honeywell, but that can be kind of a runner-up there for you. Some of you might find a creative way to trade that bullishly. Instead, what I opted to do was go to Bank of America, and I did an iron condor. As most of you are aware, an iron condor is a way to take advantage of a sideways pattern. And you can see two lines on the chart here that are black, and they represent my break-evens on both the upside and the downside. So I used the normal July monthly contracts for this, and I used the 31-32 bear call spread on the top side, and I used the 26-25 bull put spread on the bottom side, and I got filled at around 25 cents. So in other words, a 30% return on risk for this particular iron condor here. So basically what I'm hoping for is that Bank of America stays within this 3-month range for the next month or so. And if it does, then I'll make money on this trade. On the other hand, if banks decide they want to break out to the upside and this sucker's trading above 31.25 in a month, then I'm going to lose money on that side. Or if it really breaks down and we have another regional bank crisis in front of us that we don't know about and falls below 25.75, then I know what my worst case scenario is there as well. So again, a benefit of an iron condor trade is you don't have to predict where a stock is going to go. You just have to kind of predict where it's not going to go. And if you are wrong with your prediction, then you know what your worst case scenario is because it's a defined risk trade. So if it really blasts higher on a buyout announcement, or if it really plunges because it cuts its dividend or something crazy like that, remember, you're not losing incremental amounts of money the further it goes up or the further it goes down. You know what your limit is when you structure the trade, as opposed to something like, a strangle or a straddle or something like that. Sometimes there you can lose a lot more money if you're not structuring it right. With an iron condor, that's why we have the built-in bought portions of the strike. They can act as mini hedges in a way, so that way your losses don't blow up on you too tremendously. So that's what I had for you here tonight. Iron condor there on Bank of America. But I think the takeaway from today's activity was yet another very nice bullish day for the market. S&P 500 at 52-week highs. We had broad participation across the board from pretty much everything except for the utilities. And we had a number of signals through the sector rotation, through looking at emerging markets, through looking at junk bonds. A number of those things are lining up in favor of the bulls, not the bears at the moment. So hope you enjoyed the analysis. If you did, do me one favor, click like for me there on Twitter. As long as we're up and over 100 likes by the time I'm scheduled to do this the video on Thursday, I'll be happy to give you another full-length video like this. On the other hand, if you prefer the 15-minute shorter version of it, then feel free not to click like. And if we're under 100 likes, then I'll just plan on keeping it short and sweet there for you. So whatever you decide with that, I appreciate you checking out tonight's video, and I'll hope you all have a great rest of the evening. By the way, congratulations to you Denver Nuggets fans out there. How about that? NBA championship for the first time in history. So that was a fun one as well. And we'll all await the fireworks that are going to come with the Jerome Powell press conference tomorrow and interest rate decision. So stay tuned on that, and I'm sure David will be back with you tomorrow night on his take on that decision. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.